Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a daily candle chart of the Qs, which is basically the ETF that tracks the tech sector. And as I do each and every week, I leave my lines on the chart so you can see just how well the forecast worked out. And as I zoom in here, you'll see that last Friday was right here on that candle, and there was absolutely nothing here to be shown on the price action because that would have been the future last Friday. So I drew this diagonal line right here with the end of the line matching up with 281.81. And I noted in last week's report, and you can rewind this so you can see the evidence with your own eyes. I said that we would most likely hit that target on October 22nd. And look at that, yesterday's date, October 22nd. We hit that precisely and then closed with a hammer pattern right here. This long line underneath the body of that candle, known as a shadow, tells us that the buyers came in towards the end of the day and pushed it up. Now, interestingly enough, on Friday, as I record this on the 23rd, we had at one point, this was a completely red candle that was now below that blue line, which is a 20-period moving average. Now, midday during the trading session, we were touch and go because if that candle would have closed below the 20-period moving average, I'd be singing a different tune here for next week. That would have been very bearish. But the bulls came back, fought back, closed it pretty close to the highs. And as that's happening, you'll notice that on the way down, the volume is dropping, telling us the sellers are slowing down. Now, as I back out just a little bit, I want to show you that the oscillators down here are almost oversold on this stochastics. And you can see that the CCI is now starting to hinge sideways. So the CCI, being more sensitive to changes in momentum, is starting to shift. I would not be surprised if we see that start to go up. And so my forecast for next week is not going to be madly bullish, but mildly bullish as I project out just like that. The end of the line for the Qs next week, 289.45. I think we will hit that on October 29th. And this target right here is more or less a 50% retracement of what we've lost in the past couple of weeks. So I think we'll see a little bit of a bounce. Again, don't get too excited because I'm mildly bullish on the Qs, and there's a lot going on pre-election. So keep your eye on these charts and make sure you're managing risk. Now, on the other side, I'm going to hop right to the VIX, the volatility index, where I, again, forecasted that the VIX would go up. Right here, this line is what I drew, with the end of the line right there being my target on the VIX at 30.30. What happened on Wednesday, we hit that target and started to come down. Now, unlike the Qs, because the volatility index is inversely related to the rest of the markets, you'll see that this big red candle is actually forming as the stochastics are about to cross with a sell signal. In addition to that, the CCI right here, as I magnify that, you see that blue line? It's about to cross the black line or the zero line, and that zero line is known as the momentum line. So if that crosses down below the zero line, the momentum to the downside could very well accelerate. So I'm going to forecast the VIX out just like that, with my target at 25.75, again, ending on October 29th. Hopping right to the diamonds, which is the ETF for the Dow Jones Industrial Average. We missed that by just a hair. Thursday, we came down. We traded below the 20-period moving average. And then look what happened. Long shadows underneath the candle. Drop in volume. Sellers are losing some of that pressure. And the stochastics starting to go up, as well as the CCI starting to turn up. So that's all bullish. And one other thing, as I clean up this chart, I want to show you something. The divergence from the K and the D. Look at this. I don't talk about this too much, but I'm going to draw this line just like this, showing you the divergence between the percent K and the 3-day moving average of that, which is known as the percent D. And I'm going to duplicate that. Now I want to show you something, because if I duplicate that, same length, same everything, and move it on over just like that, you see that? When we had that wide divergence back here, we saw a beautiful pop on the diamonds in the days that followed this wide divergence. So I think this could, again, duplicate that same price action. And that's why, again, I'm mildly bullish all around, where the diamonds could very well go all the way up to test that high here, that target resistance area from October 12th. So again, mildly bullish, a little bit of a bounce. Long-term investors might have to suffer the slings and arrows of incredible volatility as we come into election day. But the good news is we have the charts to help us manage the risk. If you're an investor and we start dropping down or breaking out below this low right here, you really have to make sure you're trailing your stop up, because that could mean lower prices to eventually fill that gap down there. So that's the diamonds. If I look at the S&P 500, ticker symbol SPY, I missed this one by about $1.50, not that big, but we did bounce off the 20-period moving average right here. We did go lower as I forecasted we would, and the 20-period moving average is now acting as a support level. Same story as what we saw in the diamonds and the Qs. We're seeing the oscillators start to go up. We have this wide divergence here between the K and the D. See that? So we could see a snapback and eventually a buy signal cross here as prices move higher. These long shadows underneath the candle, again, that's bullish. So the S&P over the next 5 days, I don't know if it's going to get all the way up to this resistance point, but I think it's going to make a good attempt. Now, as the prices go up, it's going to be more bullish if the volume increases on the way up. If that happens, that means a sustained upward leg. If we start to see the price go up and we start to see the volume drop, again, that's your signal to manage risk, and that means trail your stop up. Target for the S&P, 351.13 on, again, October 29th. Now, finally, going to look at the Russell 2000 through the IWM. That's the ETF for that. We missed that one just, again, by a couple of dollars, but we did pull back. We are bouncing off of that 20-period moving average, and we are approaching this resistance high. Erasing all these lines, I'm going to draw something that's a little bit different than what we saw in the other markets, whereas I think that the Russell 2000 is going to break out of that high and move even higher. This is the resistance high right there from October 12th. The end of my line here on the forecast is 165.49. I think we'll see that by October 30th. And why do I say that? Because we have the oscillators already moving up, and we have this doji, which is usually a sign of indecision, but these oscillators are telling me we're going to go higher. So that's it. One last thing, I want to thank you all for the likes and the shares and the comments that you make on the YouTube channel. When I post this out, I ask everyone if they can just like it and share it, because that helps get us a bigger audience. And as I've mentioned before, the more people that watch this, the better we all do. Because imagine if you have now 100,000 people following a buy signal rather than just 1,000 people or so, that buy signal becomes much more forceful. And if we're all reacting to that buy signal, guess what? We all make more money, because the markets are moving in the direction of the order flow and the money flow, and we are all participating in that. So we actually become the driving force in the market at that point, and not the institutions and analysts who are upgrading and downgrading the stock. We are taking full control of our own money, and we're managing it with good risk management principles. So with that said, have a great weekend. We'll talk to you soon. So long.